Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, October 15th. The US dollar gained field against most majors on Monday. Crude oil dropped on fading China optimism and lower demand forecast by OPEC. And the S&P 500 printed its 46th record high this year as investors' attention shifts to the third quarter earnings, where the gap between analyst expectations and corporate guidances, so the company's own expectations, hint that, well, the third quarter results could actually be a easy beat. So we just carry on and continue to count. 46. The S&P 500 hit its 46th record high for this year yesterday, defying the recent and quite a disappointing combination of stronger than expected jobs and higher than expected inflation numbers, because they hint that the Federal Reserve should eventually slow down the pace of whatever policy easing plans it had in head a month ago. So the index traded at 58.71 level yesterday. Nvidia erased all of its summer weakness and flirted with an all-time high level as well after the company CEO, Mr. Jensen Huang, said that the next generation Blackwell chip, which suffered some delays recently, remember, is now in full production and that the demand for it is insane. And we have no doubt about it. It sounds like Nvidia is not done surprising its investors and thriving. Now, the bad news is that, well, we will have to wait one more month and even more than that before finding out the company's third quarter results. And the US is now willing to limit some Middle East-focused countries' access to Nvidia and AMD chips. But the good news is that the earnings from TSM, which produces their chips for them, will give a first hint on the strength of the upcoming numbers from Nvidia, and that already this week. And speaking of surprising, the earnings season in the S&P 500 kicked off well for the big US banks that announced their earnings so far, and they were good. And beyond the big banks, around 6% of the S&P 500 companies already revealed their third quarter earnings, and nearly 80% among them reported a positive EPS surprise. And guess what? Well, the positive vibes around the earnings could continue as we dive deeper into this earnings season, because if nothing, well, analysts cut their earnings expectations for the third quarter gradually to around 4% growth for the S&P 500 companies, whereas this expectation was around 8% back in summer. But the companies themselves have a guidance for about 16% growth in their own earnings. So that's a big gap, guys, and that actually hints that the earnings could easily beat estimates. And, well, better than expected earnings compared to estimate is the valuation's best friends. Another good news before we move on is that the S&P 500's equal weighted version also runs from record to record these days, meaning that the technology rally is broadening, even though the gap between the normal weighted S&P 500 and the equal weighted index suggests that, well, the technology companies, well, they continue to perform quite well. Anyway, with the most important and key economic data behind us now, I'm talking about jobs and inflation, the investors' attention will be mostly on the earnings this week. So today, Goldman Sachs, Bank of America, and Citigroup will be going to the earnings confessional. Then tomorrow, we will see earnings from Morgan Stanley. Again, tomorrow, ASML will be releasing its own third quarter earnings. Then on Thursday, we will focus on TSM, as I said, and Netflix results. Voila. Fasten your seatbelts. It's going to be a wild ride. In China, well, enthusiasm around the stimulus measures continue to fade as investors are now digesting the fact that the Chinese authorities didn't want to give a headline number about what they are expecting or what they are planning to spend to prop up their economy. So it's quite hard to understand right now. Either they knew that they couldn't match the sky high 2 trillion yuan spending expectation from the market, or it was just a bad management of expectations altogether. But let's agree on one thing, and is that they are not really good at communicating their plans with investors or managing the expectations, and that will probably lead to some more profit taking of the latest rally across the Chinese equities. The vulnerability to potentially soft economic data is also growing with this fading enthusiasm. So the CSI 300 index is down by 1.84% at the time I'm talking here this morning, as the Hang Seng index is down by around 1.34%. Couple of futures also come down gradually on this fading China optimism as iron ore futures consolidate in Singapore. Now, crude oil, on the other hand, kicked off the new week with a 4% decline. The US crude took out its 50-day moving average support and slipped below the major 38.2% Fibonacci retracement yesterday that distinguishes between the summer negative trend and the latest bullish reversal. As such, US crude is now back to the negative trend on fading optimism that China will hardly succeed in boosting growth with its stimulus measures, both fiscal and monetary stimulus measures, and on softer demand prospects for the global oil demand. And in fact, OPEC, they just trimmed their forecast for demand growth for the third straight month, and the cartel, said that the demand will grow less than 2% this year and around 1.6% next year. Now, the fact that OPEC is lowering its demand growth forecast could bring more delays to cartel's production restoration plans. Yes, but the recent reports, remember, suggested that Saudi Arabia is more willing to grab market share rather than chase a higher price per barrel. So, in this context, the medium-term demand and supply dynamics remain in favor of the oil bears, with one bemol though, and that's the Middle East tensions that could eventually trigger sudden and short-term price spikes. But here as well, Mr. Netanyahu reportedly told Washington yesterday that he would rather strike Iran's military rather than its oil facilities. So the next target for the oil bears is now standing at the $70 per barrel level. In the FX markets, the US dollar extends gains as this combination that we talked about before of better than expected jobs and higher than expected inflation figures from the US continue to push the US Federal Reserve those to the sidelines. Now, the Fed is still expected to offer another 25 base point cut to the US economy next month, but given the economic data of late, if these Fed expectations were to take another direction, it would probably rather be in favor of a no rate cut than a 50 basis point cut. So the US dollar index has regained half of its summer losses right now and is presently drilling above its 100-day moving average level. Trend and momentum indicators remain comfortably positive for a further rally of the US dollar, but the actual overbought market conditions actually call for a period of consolidation of the recent gains before a potential further advance against major currencies. Now, looking from the fundamental lenses, the US dollar's recent rebound, it actually does make sense as the Federal Reserve does move aside after having gone crazy and other central bank does gain filled. The dollar yen, for example, is back to testing the 150 psychological offer since the Bank of Japan considers no more hikes, no more this year, since its new prime minister said that there was no need for further interest rate hikes in Japan this year. The euro dollar, on the other hand, reflects the misery of its own underlying fundamentals, really. The stagnating German economy, topped off with a sour French outlook downgrade from Fitch, will drag the euro-dollar down to 108.88 level yesterday. We are now just a few pips above the next natural target of 200-day moving average that stands near the 108.75 level, and the bears could swallow it in one single bite. The dollar CAD just reached the 138 mark on the back of broadly stronger US dollar on the other hand, and also on the falling oil prices, while the Aussie bulls are now giving in against a broadly stronger US dollar across the board, as optimism around China is no longer there to fuel the recent rally of the Aussie. So the bears are gaining fuel these days below the major 38.2% Fibonacci retracement level, which actually hints at medium-term bearish reversal in the Aussie dollar and the growing possibility of deeper losses here. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.